The Internal Revenue Code, Section 7702, has multiple subsections, 72E, 101A, that talk about the fact that any funds received from a life insurance policy are not taxable as ordinary income and do not fall into a tax category for the IRS to recognize it as income.
Know what it takes to be a winner. Work all day, never quit, never quitter. You supply the table and I'ma bring the dinner. Call me top chef, baby, ain't no beginning, nah. I'm on a mission.
Welcome, everyone. This is the DC Incentives Podcast. Oh, this is going to be a wonderful episode. I'm excited for this episode. What about you, Naira?
I'm very excited. I think this is going to be really informative.
Well, we know we've had a lot of episodes. This one, I think, will be a classic. So, as we bring on to the stage, please introduce.
This podcast has been sponsored by DiamondCashIncentives.com. Check out these awesome merchandise we have. Wear my message and let it become yours.
Yourself.
Hello, I am Casey Dahl, formerly known as Casey the Dollar on TickTock. I live out in San Diego, California. I'm 27 years old, and I am the CEO of Power 3 Financial, which is a insurance agency. We're nationwide. Started the company because my TikTok went crazy, and that's also led me to be right here with you guys.
Wow.
I'm super pumped to be here.
All right, let's go. All right, so let's get it started. We don't want to waste no time or anything. So give us a brief bio about yourself and how'd you guys started and, talking about, life insurance and everything.
Yeah. So we'll go 2.5 years ago. For a while already, I had been doing my own personal finance, investing in the stock market. I was crazy into crypto, and I was trying to buy property. And we all know how many rules there are to buy property in the United States. Yeah, right? They make all the hoops you have to jump through.
Yeah.
So I was working at multiple different jobs, mostly sitting on the floor when I could and just trying to figure out a business plan, trying to figure out what I was going to do with my life to make a difference. And I kid you not, I was scrolling through Yelp, calling every single person, CPA, real estate agent, mortgage lender, advice from people and just all over. And I was going to buy a hair salon, in San Diego. I was going to buy a hair salon. I was going to take it over. The owner was going to give it to me. He was going to train me up. I had been working there for a while. Well, going through the Yelp stuff, and I meet this guy who tells me, once you own that hair salon, you need to get a key person insurance policy. I was like, I don't need no insurance. What are you talking about? I don't need no insurance. And insurance is for older people. Like, I don't have no kids. Like, no. Mm-hmm. And he talked my ear up for a while. I heard him out, and I was like, okay, well, thanks, no thanks, whatever. Well, the hair salon fell through. The guy was in a ton of debt, didn't want to take that on. It was COVID. And so I hit this guy up again, and I'm like, tell me more about this key person insurance thing you're talking about. Well, one thing led to another. I figured, let's give it a try. I start doing all of my due diligence, studying, reading, YouTube, and a couple months later, I got licensed. And because the IUL is one of the most fascinating financial tools that I have ever heard of in my life. And things just spiraled from there. Yeah.
So my first question is, what exactly did you get licensed in?
Hold on. You starting off with the fire, Naira.
What did I get licensed in?
Yes.
I'm licensed in California as a life insurance agent, which means I can sell life insurance, I can sell annuities, all the different life insurance products that are whole term, universal. And then I continued to get licensed in about 47 of the states that we United States of America. Yeah. So I'm licensed pretty much everywhere. And there wasn't other licenses. I did study for my Series 65 for a while. But
And
then,
what is that for our audience members and myself,
yeah,
to be quite frank?
Series 65 is a securities license. So you do assets under management, some stock portfolio, mutual funds, bonds, etc. So you just manage their account. So I was going to do that for a while. And then, like I said, the TickTock went a little crazy. And so I had to pivot and become business owner and train other agents. And so I took a step back from doing that. But there's, on top of the licensing, there's just a lot of continuing education courses and product training and different things that you do constantly. You're taking new courses, different things. So.
And you also mentioned an IUL. What exactly is an IUL?
Yeah. So an IUL is an indexed universal life insurance policy. It's a permanent cash value life insurance policy, lasts your whole life. And what's cool about it is the cash value, right? That's what everyone's interested in, because you get to mimic the growth of the stock market without actually investing your money.
Really?
Yes.
So Naira, before we get into IULs and let's first give our audience. So when we got, let's take it to the beginning phase first before we jump on right onto it, Naira.
but
so let's start off with, what is the difference between term, whole life, and IUL?
Okay. Term insurance lasts for a period of time, does not last your whole life, 10 years, 20 years, 30 years. And it's very cheap. You're literally paying for the death benefit that you purchased, and that is it. You'll never see those funds again unless, unfortunately, you die. That's term insurance. People use it to protect their mortgage, the family, things like that. Let's say $30, $500,000 of insurance. Okay.
Really? Wait, before you even expand upon that, like, how does somebody use their life insurance policy to protect their home and mortgage?
Yeah. So the idea behind term insurance is that it's a huge death benefit. So in case anything happens to you, the family gets paid, right? But also there are living benefits within all of these policies. So living benefits mean you get into a terrible car accident, you have a heart attack, you have a stroke, cancer diagnosis, something terminal, that policy is actually going to pay out during your lifetime so that you can pay your mortgage, pay the utilities bill, keep taking care of the kids, things like that. So in the event that something really bad happens to you, that policy is going to kick in and help cover expenses.
Yeah, no, really?
Yeah. And the IUL comes with that too. Some whole life policies come with these things, but that's a huge thing with term and universal insurance. Yeah. Okay, so whole life. Whole life lasts your whole life. It's permanent insurance. There is a cash value. However, the difference between whole life and universal life is that whole life has guaranteed interest and guaranteed cost of insurance. You know what interest you're going to earn every single year the day you sign that policy. You know the cost of insurance the day you sign the policy. So the guarantees kind of result in higher fees, but there is consistency throughout the life of the policy. You know what you're going to pay. You know what you're going to have. Universal is like a renewable term when it comes to the cost of insurance. It's ultimately cheap. And the point is you overfund the policy because you hope to make what the S&P 500 makes, which is around 10%. Right?
Back up. I'm trying to make that make sense in my head. So the third policy is exactly what?
The term policy?
Yeah.
Term policy, cheap, huge death benefit, only lasts for a certain amount of time.
Okay. And the second policy?
Whole life lasts your whole life. Small cash value growth, but you know exactly how much interest you're going to earn.
Okay.
Universal, cheaper than whole life, lasts your whole life, potential for higher interest earned inside the cash value.
So if it has potential for higher interest, why is it cheaper?
Because the mechanics of it, it functions like a renewable term policy. So the term policy was cheap. The fees of it are not that expensive. So if you take a term policy, you extend it throughout your whole life, and then you overfund it, all the extra cash is just sitting in your cash value, and then you have the opportunity to earn interest on it. Because life insurance companies are actually the longest and greatest investors of our entire economy. They've been investing in safe investments since before any of us were around. And they do it fantastically. What they invest in is bonds, treasury bonds, AAA bonds, government bonds, anything that is safe and has a consistent return. Life insurance companies are investing in it, and then they created this product to give you the opportunity to benefit off of their investments as well.
So we have a question from
yes.
Audience. So what is a good age to start life insurance?
If you ask me, the second that your child is born, you should be starting an IUL for them, a permanent policy. The younger you are, the better, because cost of insurance is lower for a young, healthy person. That means you have more premium going to your cash value. You have less fees coming out, but they have a longer amount of time as well. So you have 30 years compared to a 40-year-old who maybe has 20 years. And compound interest inside the IUL is going to result in huge growth of that account over time. So the younger, the better. The younger, the better.
Okay. Can you have both policies in a lifetime? So I'm guessing what she means is whole life and IUL.
You can actually have as many life insurance policies as make financial sense.
So let's say if I want 5 insurance policies, can I do that?
Yeah. As long as say your net worth is, 150 grand, they're not going to give you life insurance to cover $10 million, right?
Okay.
It doesn't make financial sense. But if you have $100,000 death benefit over here and a $500,000 death benefit over there and another 50 and another 200, that it's going to make sense, right? You're covering your butt, you're covering your assets, covering the family. So as long as it makes financial sense, absolutely, you can have more than one. It's actually a strategy that we use at my company. Have a term policy and an IUL, or even having 2 IULs, one for retirement and one for leverage.
Now, can you expound upon that? What do you mean one for leverage? What are you leveraging?
Yeah. So inside the IUL contract, there's what's called a policy loan provision. And what it says is that whenever there is a cash value accumulated in your policy, you are able to borrow from it. But what you're doing is you're loaning yourself money. It's actually the insurance company's money. And you take it out, use it for whatever you would like to. Hopefully go and make more money with it, right? Go buy real estate, go invest in something, start a business. And you put that money back into your cash value. You pay the loan back and it all goes back to you. It's back in your cash value. You can pull it right back out again. And so you're leveraging other people's money and taking advantage of your asset. Ultimately, the entire thing is collateralized by the death benefit that you're paying for.
Hold on.
Wait,
Naira. I think we're already jumping into it.
I know we're going. No,
hold on, Naira. We are jumping into it. Let's start it off first, step by step. So now we have the information, and everyone that is watching this, please get a pen, a pad, paper. This is going to be awesome. Let's get it. So now we got the difference.
Yes.
So, these questions are coming in. So, so talk to us about how now I have I want to start I want to have a life insurance policy, whether IUL or life. So I want to come to you, Casey. I want a life insurance policy or IUL. How can I set it up?
How can you set it up? Who knew that life insurance was so exciting, huh? Who would have thought? Okay, so you want a life insurance policy. If you're wanting to get it with me, you reach out. We're gonna have a conversation on the phone. I'm gonna ask you a bunch of questions. I'm gonna want to know, what's going on with you. What do you work? How much money you got in your savings account? What's the goal financially? What's the priority of the policy? And then we get on Zoom, because most people, myself included, I can't see numbers in my head. I got to be in front of my eyes. I got to see what's going on, right? So I start working on numbers. I write all of my own illustrations or policies up myself. We start going through different options, different carriers, different ideas. Every piece of the policy can be manipulated. And so from that process, it's what makes sense. What do you see value in? How's this going to help you financially? And the longest process is figuring out what you want and getting it perfect, because the application honestly takes 15 minutes. And you have to go through underwriting. You do have to do a medical, because it's life insurance. So they'll send somebody to your house, or you get lucky and they don't have to do a medical at all, but blood and urine, height and weight, blood pressure, things like that. Because ultimately they have to decide if you're in standard health, preferred plus health, or lower. So then from there, policies set up and start funding it, start building that asset.
Okay. Now that we know about it, so how much, let's say if I have, and this is can you pay for insurance in yearly increments?
Yes, you can. You can do annual premiums, monthly, quarterly, semi-annually. Absolutely.
Okay. So I want to let's say if I want to overfund the policy.
Yeah.
How much do I have to have or put into the policy to overfund the premiums?
Okay. How old are you?
Okay, I'm 30.
Okay. So if you're 30, right, and you came to me, you want an IUL, I'm going to recommend we do around 300 to start, because that's going to get you a cash value built year one immediately, right? But now you tell me, okay, 300 is easy, no problem. But I want to put more than that. Okay. So then it comes down to, do you want to put more and commit to more? You want to do that on a monthly basis? You want to do $500 a month? That's $6,000, right? Or do you want me to give you room? So you commit to 300, right? You're going to commit to 300, it's $3,600 a year. There are actually guidelines from the IRS that say, here's your minimum, here's your maximum. So we can set it up. So you're paying $3,600 a year, but you can put up to $10,000. Okay.
Okay.
Pay your $300 a month, fine. And then once or twice a year, you throw 5,000 at it, and then you throw a couple other thousand at it, and you get all the way up to that max contribution and overfund the policy, because you didn't have to put more than $300. Your minimum was going to be $1,000, but you want to put up to 10. So we're going to give you the room that the IRS says is okay, and purchase enough death benefit to put those funds into the policy. Am I making sense?
Well, I mean, you're making sense, but in terms of payment on the life insurance policy, is there an overall limit? So let's say I come to you with a desire to have a life insurance policy. Does a life insurance policy have like a limit to how much the life insurance policy is worth, like a $500,000 limit, a $1 million limit? Okay.
So if you came to me and you said, I want to put $300 a month, and we set it up, and I don't give you any room inside the policy to put more than $300 a month, you will not be able to. You'll have a limit. But if you come to me and say, whatever limit you want, you can have. If you want to be able to put $100,000 a year into the policy, we can do that. You want to put $1 million a year into the policy? Fine. You only want to put $2,000 a year? Okay. Once you decide what you want to put in, now we have limitations. Going into it, there are no limitations.
Mm-hmm. And should I pass away, and I've only been putting $300 a month for like 3 years or something, I pass away. Yeah. The amount of money that my family is going to receive, is it just the $300 that I've been putting in every month?
Absolutely not. So we'll talk the $300 example. That's $3,600. You've put that in for the first year. Let's say they gave you the minimum death benefit, right? Because that's what I would do. I would set it up with the minimum death benefit so the cost of insurance stays low in those beginning years. You're going to have $150,000 of death benefit. Okay, you paid $3,600. Well, now starting year 2, you have $153,600 as a death benefit. The next year, that $3,600 again gets added to your death benefit. Again gets added to your death benefit. And this is not how all of the policies work. This is what I do when I set them up. So if you passed away at year 3, it would have been your initial death benefit you had of the $150,000 plus whatever you put into it. So they're going to get it all. Yeah.
All right. So we have a question from Jupiter. Oh.
Yeah. How is the limit determined?
How is the limit determined? So the limit is determined by the software, right? I don't actually make the limitations, but when I have somebody tell me, Casey, I want to put $500 a month into the policy and I never want to put more than that, then I run the numbers and it says, here is your target premium, which is basically, your minimum premium. And then here is your guideline level annual premium. And so it'll tell me it's $6,215. So you are putting in 6 and you have $215 of room. And so that's where we start strategizing as far as, is that enough room? Is it not enough room? Where do you want that max limit to be?
Okay.
Maybe.
This is good. This is good. This is good. This is good. Okay. So now this is where we might want to ask you to slow it down and repeat it.
Yeah.
Now that we set it up, talk to us about the cash value.
Okay.
And talk to us about the death benefit of your policy.
Okay. So do we want to use a $300 a month example?
Yeah, let's stick with that.
Okay. So set up a policy, you're paying $300 a month, $3,600 a year. Let's say year 1, you're going to have an account value and a cash value and a death benefit, right? The death benefit was $150,000. Perfect. The account is going to be valued at around $3,000, the overall value of your account. You're going to have an available cash value of $1,500. We're going to have about 50% of our money available year 1 because the insurance carrier is learning to trust you. We just set up the policy. They're not going crazy with liquidity. Mm-hmm. Year 2 comes around. Now we have about $2,500 of liquid cash. Our account's going to be valued at about $6,000, and we have 150 plus in our death benefit. So as time goes on, we have more and more money in our cash value. Our death benefit is getting higher and higher as well. They're both increasing. The overall value of our policy is increasing, but the value and the amount of cash value are not the same yet because there's still the cost of insurance, right? In those beginning years, we're still paying the cost of insurance. We're basically buying the benefits of life insurance. We're buying the benefits of life insurance because let's say you're on year 6, right? Year 6, I was just going to do 3,600 times 6. So we put in $21,000 into the policy. Probably having our accounts valued at about $19,000. We're starting to pay off cost of insurance. We're starting to earn enough interest in the policy that it's paying for itself. Because if you're earning 7% and the underlying policy is really just a renewable term policy, cost of insurance isn't that expensive. And so we start to see those numbers even out.
Mm-hmm.
So we have 15 grand in our cash value at this point, year 6 of paying $300 a month. If you wanted to loan money to yourself, you guys stop me if this isn't where you want me to go, but if you loan money to yourself, let's say you want to take out 8 grand. You have 15, take out 8, take the 8 out, and you're going to go invest in something. Maybe it's a year-long investment. You're supposed to make a certain amount of interest. You take that loan out, it's year 6. The interest rate is 1.5%. 1.5% to borrow the 8 grand.
Mm-hmm.
You go put it over there. You're supposed to make 10. You're supposed to make 10 grand. Technically, you don't have to pay the loan back in a certain amount of time because you're paying for over $150,000 in death benefit. And that death benefit is going to pay off your outstanding loan when you pass away. So there's no limitation on paying it back.
All right.
Okay. So, oh man. All right. So now, don't mind me if I'm down. I'm just like, people are just coming in like, oh my God. What? Like people, we got questions after questions after questions while you are explaining yourself.
Yeah.
And everyone that is watching this, please share this with someone that needs to hear this. This is essential.
Mm-hmm.
This is essential.
So
not wrong. We do. I'm looking at these yo. All
we
right,
really have that many comments coming in.
Yeah. So let's get to them first.
All right.
And then your question is gonna be answered, and then I want her to like break down what she mean as what you mean when you talk about taking a loan out for yourself. Okay. So can I have life insurance for my business?
You absolutely can. Your business, your LLC, S Corp, C Corp, sole proprietor can own a life insurance policy. There's going to be so many reasons why they could do this, or why you'd want to do this, but they own the policy, they pay for the policy. You, as the owner of the business, are the key person insured, which is the reason that I learned about all this stuff, is because of key person insurance. Immediately add value to your business. That death benefit becomes more value to your business. All of a sudden, you're building a cash value that ultimately you can leverage and grow your business further. Or some people even pay themselves a supplemental income out of the cash value, because you guys, we haven't even said that loans aren't taxable. Loans aren't taxable. So when you take money out of that cash value, you pay yourself a supplemental tax-free income.
Hold on. So wait. So you mean to tell me if I life insurance policy, even if it's my business or for me personally, it's not taxable? The IRS will not tax me?
Those loans coming out, they are not taxable. They are not ordinary income. They're not portfolio income. They're not investment income. They're not passive income. They're loans from a life insurance.
That's a federal law. That's not a state law.
Yes, sir. The Internal Revenue Code, section 7702, has multiple subsections, 72E, 101A, that talk about the fact that any funds received from a life insurance policy are not taxable as ordinary income and do not fall into a tax category for the IRS to recognize it as income. There are tax codes on the growth inside the cash value is not taxable. It's not on your taxes each year. You don't have to claim it. When you access the money, it's tax-free because you're taking a loan. You're leveraging your asset. If you leveraged other assets you have, it's the same thing. And when that death benefit gets passed on, whether it's to you because of a medical emergency or to your family, it is also tax-free because any income from a life insurance policy is not seen as ordinary income.
Wow.
So it's,
That whole phraseology, ordinary income, is just skating by.
Yo, the juice is pouring. The juice is pouring. The juice is pouring.
So business, man, yes.
So is it easy to increase our limit as our income increases?
This is a really good question. Like a really good question, because if we don't set it up for the limit to increase over time from day one, it won't increase. But there are things we can do. We can plan for income increases, right? Maybe we plan small. We plan every 5 years, let's increase the amount of money we're putting into the policy by $50 a month, right? Things like that. We can plan for those steps up inside the policy. But if you're under 35, okay, this is another reason why young people need life insurance, especially permanent cash value life insurance, because you can add on a guaranteed insurability rider that says if you're 20 to 24 and you have a policy, you have this rider 6 different times in your lifetime up until your age 40, you can add more death benefit to your policy without proving that you're insurable. When you up the death benefit, you up the amount of money you can put into the policy, because you buy more death benefit, you get a bigger cash value. And so young people have 6 opportunities. They don't have to commit to it though, which is, I think, the best part. Say they really want to increase their premiums. And so they add this rider, and a couple years later they add some death benefit, maybe $25,000, and that lets them increase their premium. Perfect. Well, in 2 years from then, they say, I don't want to raise it. I'm good right here. You know, things are going on. Life is happening. Okay, perfect. Don't use it. But 2 more years, so 4 years later, they decide, you know what? I'm in a good place. I want to up it again. And they can add more death benefit, put more money into the policy. So my young people, the flexibility and the overall usefulness of these policies can be insane if you do it right with the right person, of course. If you're helping.
So we have a question from Jupiter Opulence. She says, she asks, if our health deteriorates, does this change the value of our life insurance?
Good question as well. No. And I'll give you an example of that's easy to kind of put this into perspective. If you're a non-smoker right now, right, you get a policy and you get approved as a non-smoker, right? Mm-hmm. But 3 years from now, you start chain smoking, you're heavily smoking. Your policy is not going to change. You're still, if you passed away, that policy is going to get paid out to you as if you were a non-smoker, because they gave it to you as a non-smoker. I asked this actually, when I had first started, like, oh my gosh, like if someone decides they want to ride a motorcycle now, or someone gets cancer and they have this perfect rating for their health, do they need to up their policy and tell the life insurance carrier, hey, this is what's happening? And the regional manager for one of the life insurance carriers tells me, Casey, why would they call and tell us, hey, you should charge me more because my health isn't very good?
Right. That doesn't make no sense.
That's a good point. Like, no, once the policy's set up, it's set up, and that's just how it is. So another reason, perfect example of why you should get it when you're younger, before all of these things start happening, because it can be taken away from you.
Okay.
Gotcha. Can I give my employees life insurance policy instead of a 401k?
You can do that. I know. So it's called a life insurance benefit, an IUL benefit for your employees. And say, as a business owner, I have 7 agents, right? Well, if I wanted to, I could offer them all IULs. My company would pay for a portion. They would match like a 401k does. They would get to put money from their paycheck into the IUL as well. And it would be a tax write-off for me, and they would ultimately have a tax-free cash value to use later on for retirement. So absolutely, it could. There are companies that do it right now. It's called dollar cost averaging, which is really cool. And this is like big dreams of, I want to go into businesses and be like, hey, stop doing these 401ks. You need to do this instead, because everybody wins with the IUL compared to the 401k. The employer wins in the beginning, but 30 years later, what does the employee get?
Right.
ripping it
So,
all.
so in your professional opinion, you think the 401k is not as great as using a life insurance policy in its stead?
I don't. And of course I'm biased, right? Of course I am.
Yeah, of course.
But the 401k, it's nice right now because you don't have to pay the taxes on it. Okay. Like that is nice. So you're going to save taxes for later. But at the same time, that's the problem. Taxes are going to go up. They go up, they go down. You never know what tax bracket you're going to be in when you retire. And so you can't plan for how much money that Uncle Sam is going to take away from your 401k. And it's not liquid to you. You can't touch it until you're 59 and a half without paying a penalty. There isn't the life insurance benefits. You can't loan out of the money whenever you want to without, again, paying a penalty. I don't think that people should stop funding their 401ks. I think you should take the match if you're getting one. But I think there is 100% space at the table for an IUL in everyone's portfolio because of the liquidity and the tax-free advantages later on.
What about the long-term growth between the life insurance policy and the 401k? How do you measure that? Which one is better? Which one is worse?
Yeah. So
Naron, I'm sorry. I have plenty of questions coming my way.
All right,
so I know you have thousands of questions.
Sorry, Naron, you're gonna have to wait.
Yeah, that's all right.
No, but go ahead, Casey.
You want me to answer?
Yes.
Okay. 401k. Sure, you get to benefit off of the stock market. You can have great returns, 7, 8, 9, 10, 15%. Sure. However, it's not included the taxes that are going to come out, 20% or more is going to come out of there. And then the real differential piece of this between the IUL and the 401k is when you do get to retirement. If you have $1 million in your 401k after taxes, all of it, you can start pulling out 4%, right? The 4% rule. So that's fine. But when you pull out that 4%, you're devaluing the overall asset, right? You're taking money from it. You're using the money, so your asset is shrinking, which that's how it's supposed to work. It's not, a bad thing. That's just how it works. But so when your funds are still sitting in your 401k, they're sitting in the market, you could take a hit on your portfolio as well when you're pulling that money out. And if you do earn interest, you're earning it on a smaller amount of money because you're pulling from it. Now, the IUL, the $1 million that you have, if they both had $1 million, well, the IUL is going to allow you to take more than 4%, around 7% out of the IUL, because when you take that 7% out, the value of your asset is not going to decrease. You're leveraging, you're taking a loan. So you're still going to earn interest on $1 million that next year. And the year after, you're going to earn interest on more than $1 million because you're still only earning from the positive returns of the market, because the IUL has a 0% floor. You cannot lose to the market. And so every year you're taking that 7%, but maybe you're earning 7%. And so it's this whole cycle. 401k does not do that. You take it out, it's gone.
All right, let's get to these questions.
Okay,
I don't think my questions is going to be answered today.
We might have to come back.
How many years commitment is payment of the premium?
For the IUL, you could fully fund an IUL in as little as 7 years.
What about whole life?
Whole life is going to be a lot longer. Whole life, most of the time you're paying until you're 90. Now it's very small premiums. Maybe it's $600 when you're older. But still those premiums don't stop. IUL is different.
And for term, it's no different, right? Or am I wrong?
Term, there's not any cash value. So there's nothing to show for it.
So to me, it just seems like term, when you have a term, this is just my opinion. It just seems when you have a term insurance, it seems like it's a gamble.
Yeah, it is. It is. You're betting on, I'm going to get this term policy because I might die in the next 20 years. You could be a healthy 25-year-old going, do I really think I'm going to die in 20 years? Or am I going to live for 50 years and in 20 years, I just won't have insurance anymore? Right? Because it's over. It ends. You go from paying $30 a month for that 20-year period. And on year 21, they're going to say, okay, it costs $5,000 a year now. It costs $10,000 a year now, or you can start over and we can see where you are physically, your age, your health, get you a new policy. It's going to be more expensive. And then you're again betting on, am I going to die in the next 10, 20, 30 years or not?
Gotcha. That's boss. This is boss after boss. If my LLC and I both have insurance policies with my children, will receive both if something happens to me?
Good question. So the LLC has a policy and then you have your own policy. Well, if the LLC owns a life insurance policy, it's the owner, the payer, and it's the beneficiary, because there's some weird situations you can get into if I have a business and the business owns a policy and I put my sibling as the beneficiary of the policy, then they call it a Goodman's triangle. They say that too many interested parties are interested in this life insurance policy, and it can create taxable events that we don't want. So we always want the business to be the beneficiary of the policy. And so that means whoever is going to take over the business is going to receive those funds, or you set up a trust and you say the money that the business inherits is to be used for this, or it's to be given to the kids. You can do a couple things there. With trusts are really important with life insurance. But so if your business was going to be inherited by your children, then they would get the money. And then if your personal policy had your children as your beneficiary, they get the money as well. So there's just a few things to set up and think about long-term with a business-owned policy.
And I'm happy that you said long-term, because life insurance, we have to think about this long-term.
Yes.
Okay.
100%.
Oh, this is a one. Naron, you want to do this one?
All right. Third option asks, what can negate a policy?
Negate as in like what can cancel?
Cancel.
Yeah. Okay. So what can negate a policy? You overloan money to yourself, right? Something people say in the industry a lot is that there are a lot of people that get these policies and then they use them like ATMs. And this is not beneficial to the policy. You can't just go and keep pulling money, because there is interest on the loan, right? So that interest will accrue and drain your policy if you're not being careful, if you're not paying it back. And then something else that would negate a policy would be the agent who you're working with sets it up totally incorrectly, as in you want to pay $300 a month, right? And they give you $1 million of insurance. And so you're trying to build a cash value where you're barely making the minimum premium. And so you're not going to see that policy go anywhere. Another one would be you're just putting lower amounts of money into the policy when you should have been paying that $300, and maybe you have some bad years and you skip some premiums, things like that, not paying for it. Then one that, because it's mimicking the stock market, right? If we were to see, because we're technically in this weird kind of recession, not really recession economy right now. If we were to see the market just crash over and over again, we're going to have 0% interest credited to our account, right? So if that's happening for a long period of time, we're not really earning any interest, which is unfortunate, which this would have to happen for 10 years in a row, right? To really not see any growth in the policy. But there are also ways to earn guaranteed interest inside an IUL. There are going to be indexes that have guaranteed interest rates so that even if the market does crash, you're still maybe going to earn 3% on a portion of your money. So there are ways. What were you going to say?
Yeah. So how does an insurance policy guarantee the 3% even during down years?
Yeah.
What are they betting against?
So all of these bonds, right, that they're investing in, they're safe investments they have. So if their money, if they have a ton of money in a AAA bond that earns 4.5% every year, right? That's just how it works. Mm-hmm. Well, if they're putting all of their money in there and they say, hey, as a policy owner, if you want, you can also put your money here. You'll earn 3%. We're going to keep 1.5, right? You'll earn 3% no matter what. And that's just how it is. You put 20% there. That 20% is guaranteed to earn 3%. And so that's a way to hedge against a recession. And then if 20% is there, that means 80% is with the S&P 500, the NASDAQ, the Russell, hoping to earn more interest than that, right? So it's all about what they're invested into and then what they can offer to policyholders. And then the agent having the client's best interest in mind to then utilize those features.
This is too much sauce. Okay. So this is too much sauce. Okay, so let's get to the next question.
And I think we answered this one, yeah.
I believe we did answer this one. Yes. Okay.
All right. For the audience members that can't see this, Jupiter Opulence writes, I think I love Casey. I'm 23 and telling me things nobody in my family can tell me. If I asked elders in my family about life insurance, they would say I'm too young. I don't need to worry about it. Yeah, I think that's a stigma for a lot of us. Maybe it's beyond the African-American community, but for a lot of us, me included, this is the first time I'm really getting some information about life insurance policies.
Yeah. I got lucky to be in the position that I am and to have learned this information. Like I said, it was totally random. And I, even to this day, you guys, my parents don't want to talk to me about life insurance.
Why? Because you think about that.
Me about it. Right. My friends know what life insurance isn't cool. I think it's cool. People on TickTock think it's cool, but if you don't know somebody in your life, that has this information, you probably just think life insurance is a scam. It's for old people. And it's really quite the opposite. But that's what the government wants us to think. They want us to be putting our money into accounts that they approve of so that they get their taxes later. If everyone was doing this, they'd be upset. And so this information is not readily available to anyone at all.
And you know what? That comment sort of answers the question I had.
Yeah.
But Rich, do audience members have a couple of more questions to ask?
Yes. So Casey, as I'm looking down, just letting you know, I have people asking me questions here, and I have people so I'm like listening, and then I'm all over. Yeah.
Good.
So there are more questions. How much are your services if we start a life insurance policy with you?
So it's actually against compliance for me to charge anyone to work with me.
What?
Yeah. I can't charge anyone for my services at all.
So how do you generate a profit?
Yeah, I get paid by the insurance carriers. I work on commission. So everything on commission, a portion, like a percentage of not the person's premium they're putting in, right? But based on the size of the policy, it's actually the minimum amount that someone has to put into their policy. So if you're paying $6,000 a year, and that's your max limit, right? We've set it up so you're overfunding that policy, and your minimum was like $1,500. Then I'm going to get paid a percentage based on the minimum that you have to put into the policy. And so I get a commission from the life insurance carrier, and we move on.
Okay.
Yeah, so it doesn't come out of the client's pocket whatsoever.
There are so many positive. What are the negatives? Okay, so pros and cons. Casey, you wanna? This is where the God's advocate comes into place. You're like, all right, I want to play devil's advocate. I'll say God's advocate. Play. Okay.
Cons are, I would say, I mean, if there's people who are listening who are older, cost of insurance just gets way more expensive. You start reaching that 45, 50-year-old age. It just does. If you don't have the best health, say you have diabetes, you've had cancer in the past, things like that. You take medicine for depression, anxiety, anything really. If you're not going to get that standard rating and you're not really interested in the death benefit, you're doing this for the cash value, you're just going to see much slower cash value growth. And if you can't put a lot more, like the worse health that you're in, you have to put that much more money into the policy. So I would say that that's one of the downsides, is that it is life insurance. And so it is based on your age, your gender, your health. And if those things aren't standard up to the life insurance company's standard, then it's just going to be a lot harder to really grow that cash value. And then there is a 10-year surrender period. So the first 10 years of the policy, they say that if you cancel, they're just going to charge you 10% of the cash value. And so getting out of the policy in the first 10 years can cost you. But once you get to that 11th year, there is no more penalties for the surrender period. That's over. So it's a commitment, and there are limitations on how well your policy works based on you.
Gotcha. Okay. So since we want to talk about pros and cons now between life insurance policy, let's speak into a reality now.
Okay.
Unfortunately, if you live in any other state other than New York is tough for us because I live in New York, Nara lives in New York. So because we live in New York State, and Casey, tell me if I'm wrong or anything, and you can explain this but New York makes it tough for us, as because we live in New York. It makes it tough for us to, you can say, infinite banking or be our own bank or overfund policies because we don't have because of our disposable income is not enough. Casey, am I correct?
Well, I live in California, so I.
You're in the same boat. You're in the same
boat. But what makes it even harder in New York? I mentioned I have 47 licenses. New York is a state that I do not have because they make it so hard to even do business in New York that it has taken around 6 months to even be at a place where we're almost kind of there. They regulate things to the max. There are special insurance companies that offer like a New York product that only works in New York. And then, and I hope there's not all kinds of New York people listening to this right now. There probably is. I'm sorry, you guys, because I have access to a few at this point, and I've shown them, I've worked with them. But what they do, how I said the death benefit is ultimately what you're purchasing, right? And the amount of money that you put towards it, you got to pay, an equal amount of what you're purchasing, and then you want to overfund it so you have a cash value. Well, they're gonna, if this is California and they just make you purchase, up to their standard, the amount of death benefit, New York's gonna go like this. They're gonna say you got to purchase more death benefit and you got to put less money. You can put less money towards this bigger death benefit, and so it really just it makes it even harder, So,
it really does.
Some crap. It's honestly some crap, but Go ahead.
Yo, Casey, thank you for So even there's positive, but yes, there's pros and cons to life insurance. And Casey, thank you for speaking to reality too. Thank you for that.
Absolutely, guys. It was a pleasure. It was a pleasure.
Oh no, we're still going.
We're still going. Oh no, we're still going. We're still going. Oh no, we have more.
Okay.
Don't be deceived by Rich. Don't be deceived by Rich.
Don't leave.
So I want to touch base. It's so many questions.
Yeah.
So I know Nairon has a million questions.
Listen, the audience is taking over today. The audience is the third interviewer. Apparently, I've never seen the audience have this many questions. So, what's the next question for our audience, Rich?
All right. So, we don't have any for right now. So, I want to get into. Let's talk about dividends.
Okay.
And let's talk about I want to go back to when you said about the IUL, about the S&P 500, and please break that down. We could talk about the dividends first.
Okay. Well, so fun fact, there are no dividends in Index Universal Life Insurance. They do not pay out dividends. However, Whole Life does. Whole Life has dividend options. I'm not as familiar with dividend paying Whole Life. I work on more infinite banking Whole Life, which means that the dividends are kind of worked into the cash value already. They're not like an extra bonus you're going to receive to your cash value. But with Index Universal, there is an index. It's called the Fidelity Index. It's one of the carriers, and it is a dividend earning index. But the dividends don't actually pay out to the policyholder as a dividend. The insurance company gives you a bonus. And so they're receiving the dividend, and then the policyholder is getting a bonus because of the dividend. So that's one of the indexes, how it works. It offers a 1.65% bonus on any money allocated to that specific index. And so policyholders are getting a little bump, a bonus in their cash value because of certain indexes.
Yeah. Okay, so if we get different types of whatever the insurance policy is for Whole Life, we get dividends quarterly or annually?
It's going to be an annual. Most things in life insurance are annual. Like it might technically be credited inside your policy monthly, but not actually earned until the end of the year.
Gotcha. All right. So now let's get into IUL now. The interesting. So when the S&P 5 actually break it down, please explain it.
Okay. So you're going to have S&P 500, a monthly S&P 500, a spread, a cap, and one with a bonus, right? So you're going to have variations of the S&P 500 index that you can use. And then there's going to be Russell 2000, the Fidelity, the fixed account, other options. So you tell me, I want to use the S&P 500 with a cap. Well, the cap is 8.8%, right? As an example. And
I'm so sorry to cut you up, but when you say you want to use it as a cap, what's exactly a cap in relation to an insurance policy?
Yeah, absolutely. So when you're looking at it, you tell me I like the S&P with the cap. The cap means that you'll only earn up to whatever the cap is. So if it's 8.8%, your policy is going to be credited up to 8.8% based on what that index did. If it returned 10, you're only going to get 8.8. Right?
Why would you ever want a cap?
Caps are good because we already have a 0% floor, right? So it's an index policy, meaning it's tied to the market with a 0% floor, and then it's capped, right? So you can earn 0 to 8.8%. So you don't always want capped indexes. I don't think anyone wants capped indexes, but they're good because that's how indexing works, right? Now, maybe you want the S&P with no cap and a spread rate, right? Mm-hmm. So what that means is that the spread rate, say it's 5%. Well, you earn everything that the S&P 500 returns over 5%. So if the S&P 500 returns 15, you're going to collect 10% that year. It's not capped on how much you can earn, but you do have to beat the spread rate, right? So that would be an option. And so if it did 15, you earn 10, 10 is going to be credited to your policy. So there's going to be different variations of the S&P 500. And right now in this time, I wouldn't choose the spread. One of the companies that I work with has a 7.5% spread rate. And so it has to get over 7.5. And I don't believe the S&P 500 is going to do that this year. So I'm going to cap instead. So if it earns 4%, we at least get to earn 4.
And when you say earn 4, that money's going where?
To your cash value. It's going to be credited to your account and be available in your cash value.
Gotcha.
Yes. Yes, yes.
If I am a single person with no dependents, should I still be considering an IUL?
Yes, absolutely. 100%. Because you got no dependents. You got nobody that you're taking care of, that you're spending money on. Eventually, you're going to wish that you had started the policy so you have a cash value to fall back on. And if you don't start now when you're young and healthy, then you're going to end up paying more at once later on. So absolutely. I got no partner, no kids, no mortgage. Absolutely.
So what you're saying is you're on the market. Hi, I'm married. I don't know if he's married. Yeah. Call me after the interview. You just said the magic words.
I did. Yep. I let out some secrets there. Huh? Yep. Single. I'm a great spokesperson for life insurance. You don't have to have anything to get life insurance. I'm alive, right?
Right.
All right, I got more questions right now. So Nyron, I'm sorry, for the S&P 500.
Yeah.
When we about an IUL, let's say we get into a recession, and the S&P 500 goes down to 0.
Yep.
For the IUL, is it true that you get your money just stays there? Is that true?
Yeah.
You can break that down to me.
Yeah. No. It earns 0, and maybe you had, let's say you had 40% of your money allocated to the S&P 500 index. It went to 0. You earn nothing. You just stay the same as last year. That's where we want to be utilizing that fixed account, so that another 20% of your money earned 3% in a down year. So there are ways to combat that. And I think too, because I don't want to skip it, when the economy crashes, return 0, and you're not using the fixed account, okay, you're going to earn nothing. You're going to earn no interest. You earn no interest. Your account doesn't change because of the no interest, doesn't go down, but you still do have to pay the cost of insurance. So that cost of insurance is going to come out of your cash value or within the premium that you were paying, right? So that could decrease your cash value because of the cost of insurance, which is why I'm always going to use the fixed account no matter what. I just had an insurance professional yesterday tried to tell me that was she told me it was lame, because why would you want to not risk all of your money? And I was like,
she literally used the word lame.
She didn't say it was lame. That's what it sounded like to me. She was telling me I would never use the fixed account. You're going to miss out on interest. You're going to prevent yourself from earning, more interest with other indexes. And I was like, and she is not someone who actually sells the insurance, right? She's somebody in different insurance companies doing something marketing. And so I got in a fight with her in front of my whole company. And I was like, not in a fight, but just like just so you know, Sharon, I use the fixed account every single time. And we all do, because the second that somebody has a 0% year and they're going, Casey, I didn't earn any interest. Like, what the hell, blah, blah, blah. If I know I could have put money into the fixed account and earned them something, and they would have been going, oh, wow, thank God we used the fixed account, and I knew that and I didn't do it, that's my career. That's my client who's pissed at me when all we had to do was take a portion of the money and put it over there, guaranteed interest. I don't care how not exciting. That's a word that's used about the fixed. It's not exciting. You're just going to make sure you always earn something. Yeah, it's life insurance. It's not an investment. It's a safe, reliable product. Make it safer. Make it safer. And I do everything conservative like that. So because I don't want that year to come where someone didn't earn anything and they did see their cash value go down because of the cost of insurance. It's not going to happen to me. It's not going to happen to anybody that I work with. I don't, I am not a huge risk taker, and I have good reason behind it with what I do.
I mean, look at the state of the economy.
Yeah. How could you justify putting all of your money at risk?
Right.
Don't have to.
And this is the reason why it's important when we work with you to, as long as your policy is set up correctly, that is when. Can you talk more about that? As long as our policy is set up correctly.
Yeah. The policy is set up correctly. You're going to have a minimum and maximum annual premium that you're comfortable with. You're going to start off with the lowest amount of death benefit for the amount of money you're putting in, which means that we maintain a low cost of insurance, and you're going to have a cash value built in year one. That's what a correctly structured policy does. It starts accumulating the most cash we can possibly get from that policy. And then the funds that are earning interest are also diversified, so that worst case scenario, we earn something no matter what when everyone else is losing. And that is a properly structured policy. It's a non-MEC, which means that whole entire cash value is not taxable. MEC stands for Modified Endowment Contract. As soon as the policy becomes a MEC, the entire cash value is taxable. So the words non-MEC should be on every single policy. You should have diversification, and you should have the minimum death benefit with limitations exactly where you want them.
Okay, hold on for a second. All right, so hold on. So you're going to have to explain that one more time. I'm sorry. So you said it's a modified endowment contract.
Yes.
Is it okay to repeat yourself just one more time and to break down what is a MEC, modified endowment contract? Please explain.
A modified endowment contract is basically a 401k. Okay. So it's a life insurance policy turned 401k. It's called a MEC. And to the government, that means your non-taxable life insurance policy has now become taxable. And every time you touch the cash value, we're going to tax you on it. And also, we're going to penalize you if you touch the money before 59.5, just like that. And so how we avoid a MEC is by staying within the guidelines that we set up ahead of time. If you're supposed to be, your limit is $6,000 a year, and year two, you put in $7,000, your policy's a MEC. You just went outside of the guidelines. Stay inside the guidelines, keep it a non-MEC. Don't let the government tax your money.
Is MEC another way of saying overfunding?
It would be you literally overfunded the policy to the point where it became a MEC. Yeah.
Okay.
A better word, I guess, when we were talking about overfunding is max funded, because when you technically actually overfund the policy, it becomes MEC. So you want to max fund it. You don't want to overfund it to the point where the IRS says, hey, I'm coming for your cash value.
Right.
Yeah, we don't want that.
Gotcha. So when can we look for when we are not on the MEC?
What do you mean?
What can we look for in our policy when we don't want to?
Yes, it should literally say this illustration is a non-MEC. Like every single illustration that you get, it should say that. But here's the thing: unfortunately, a lot of agents never send their clients the illustration.
And the illustration is exactly what?
The illustration is going to be the policy in like a sales concept-y form, saying, here's the name, the initial death benefit, all of the key definitions and explanations about ultimately the numbers. You're going to see your premium going in, your cash value, your death benefit, and the outcome of what that looks like in 30 years, right? So inside that illustration, it will clearly say this is a non-MEC or this is a MEC. And so I send illustrations out to everyone who I show one to, right? But agents out there do not send out their illustrations to their clients, meaning that as a potential client, you could miss that information if you're not asking that person, hey, I need you to tell me this is a non-mech. I need to see it. Because unfortunately, it can become a mech without you even realizing because they're withholding information.
Right. So when you overfund, you don't get any sort of notification like a bank would give you if something's wrong with your account or something's going on with your account.
So if it was set up that way, they're going to say, hey, sign this mech notice, right? So that would be one way. But then, yeah, if you overfund it, they're going to say, hey, your policy is now a mech, and the agent's going to get informed too. They will. They'll notify you that it's going to become a mech, and sometimes they'll even let you say, hey, okay, I don't want to put all that money in there. But if you don't know what a mech means, you're just, okay. You know what I mean? So it's hard. It's difficult because this information, how would you know? How would you know? Right?
Nyron, we got 2 questions. So after the 2 questions, Casey, I'm gonna ask you about going back to the. I'm gonna ask you going back to the mech to explain about, now that we looked at it, how can we avoid it? So the first, shout out to Aquarius Queen. Are there any requirements to get insurance on an LLC as humans? Some policies require a physical checkup. What will be needed for an LLC?
So if the LLC owns a life insurance policy and the business owner is the key person still has to do all the same things as a personally owned policy because it's still life insurance. So someone still has to be the insured. Yeah. You better let Nyron have some questions.
All right. Okay. I'm sorry. I'm sorry.
For those who haven't seen what the beautiful, wonderful, amazing Jupiter Oculus just said, she's just basically advocating for me asking questions.
All right. So,
but our audience members take precedent. It's important that they get the information that they came on this channel to see. So after they get a couple questions, and then I'll pebble you with whatever I have left.
Yes. You know what, Nyron? I'm gonna ask you. You can ask all your questions after this.
All right. Yeah, that's fine.
Okay. Once a policy is purchased, do we need to relook at it yearly, or is it one and done if it is set up to our liking, say for a 45-year-old?
Yeah. So 45-year-old, if we got a plan for the next 15 years, there's no reason to change anything. Everything's set up the way you like it. Perfect. We're probably still going to touch base once a year because, like I mentioned, that fixed account, maybe we were putting 20% into it when we started, but we are going to have the opportunity to change the index allocations. So maybe on year 5, the economy is doing great and you say, I don't want to put 20% into the fixed account anymore. I want to change it. And so we'll do that and switch up the index options. And that would be for everybody. Every year we can change the index options. And so there's always something that could be updated, but otherwise, because that's something I would do. I'd be going, hey, Nyron, we got to change your indexes. The economy's doing great. Let's put a little less in the fixed account, or I want to use this index. What do you think? We fill out a form, we send it in. But you could also, we talked about a rider earlier. Like if you wanted to use that rider, where you're going to have to get in contact with me. If you want to take out a loan and you have questions, you're going to get in contact with me. It is not a one and done. My company, Power 3 Financial, actually prides itself on the fact that we want to create relationships and that our customers, I never said that word. Our clients, I'm so sorry. Our clients, we have long lasting relationships with them. This is your money and it's a commitment. So we want you to feel like you always have somebody to go to and ask questions and get help and make changes, things like that. Yeah.
Okay.
All right. Go ahead, Nyron. All you.
Look at his face. Look at Richard's face. No, I guess one of the primary questions I have, and I think you answered it when you talked about the 50 states, it seems like the life insurance industry is almost completely privatized. Is there any sort of government-funded life insurance policy or anything along those lines?
So life insurance is actually, it's regulated by the state. It's down to each individual state, and they do regulate it a lot. The government only regulates the tax code, right? They regulate the tax code, and the tax code, because TEFRA and DEFRA actually apply to life insurance, and specifically,
TEFRA and DEFRA, what are they?
They're just laws about life insurance investing. And ultimately, it's about those guidelines. It's about the guidelines as far as how much money you can put into a policy for how much death benefit, right? Mm-hmm. So the government regulates those laws that apply to life insurance, but then it's down to the state level. Like I mentioned, New York is a tricky as hell state to even do business in, whereas other states gave me the license in 10 minutes. Other states made me go and do more fingerprints. Other states made me go get a notary signed at the bank. Like every single state has different rules and regulations on who's licensed, what products they sell, and the features inside the product.
Okay. But I think more specifically what I'm asking for, you know how with health insurance you have Emblem Health and
is there
a government, is there an Obamacare version of life insurance policy?
Nope.
Wow.
No, it's not.
Wow. That's fascinating. All right. And my second question would be, you can withdraw after a certain amount of time. I understand the mechanics of how withdrawing money from your policy works, right? You put in a certain amount of money, and after like the first year or so, you can withdraw a limited amount, and whatever it is that you're withdrawing is against the entirety of the policy. So if you took out $1,500, it's really against the $150,000 value of the policy itself, right? Yeah. What is the difference between that and a bank, right? Like, what are the essential differences between the policy statement and a bank?
Yeah. So, I mean, if we have a savings account, right, and you have 10 grand in your savings account, well, it's only earning 0.01%. Right? Something ridiculously low. And what the bank can do if you put money into a savings account, say you have $10,000 there, well, the bank goes and loans your money out to other people. And they're charging 10% interest, mortgages, car loans, different things. For every dollar you put into the bank can loan out $100. Right? So when you put money into the bank, you're barely making anything on it. Not enough to like pull more than 10,000 out. If you have 10,000, you have 10,000. You pull out 1,500. Well, now you only have $8,500, and that 1,500, you're spending it on whatever. If you have $10,000 in a life insurance policy where you're hopefully earning around 8%, even that 10%, you pull it out at 1.5. Well, you're still netting, say that 8.5%.
7% total.
Yeah, and your policy still earns money on the entire amount as if you hadn't touched it. So it's a difference of having an asset that doesn't lose value and keeping your asset in the bank so that the bank has more of an asset.
But you can't like withdraw money out of your policy like you would a bank, right? There's no life insurance ATM machine where you have a life insurance card and you want to take out some dough. That's not how it works, right?
So if you have a policy, right? Say you have a policy and you have a cash value, you got 15 grand in there. You log into your back office of your policy and you type and request loan in 72 hours to my bank account.
Really?
I promise. I know. Yeah, it is kind of 72 hours. It's not immediate.
Right.
It's 72 hours.
Yeah. So I could see the usefulness of a life insurance policy in terms of if you need a loan for a car or if you need a loan for a house.
Yeah.
That makes sense. But if I wanted to go to the barbershop and I want to pull 20 bucks out, no, I wouldn't go to life. Okay.
No. You hopefully will make money with the money you're pulling out.
Hopefully, right?
Yeah.
In terms of paying the money back once it's withdrawn, how does that work?
So like there is no time limit on paying it back because death benefit is fully collateralizing it. So unless your cash value is about to hit zero, you're going to have no money in there. That loan is not going to be payable and due until you passed away.
So if I take money out of my policy for the entirety of my life, theoretically, I could pay it back when I want to. And if not, it's just going to be taken out of whatever's left in my policy.
Yeah.
So there's no creditors hounding me, nothing along those lines, reminding me that I got to pay whatever I took out of my insurance policy.
No.
What?
I know.
I've never heard of something like that.
I know. I know. Me either. I know.
And do life insurance policies have any tie to your credit score?
Nope.
None?
No. No. I know. And you know what? Okay, I'll give you one even better. So let's say you were going to get Social Security, right? You guys, we're not going to get Social Security, any of us. It's going to go. But let's pretend we were going to get Social Security. We're going to get Medicare, Medicaid, all of these government benefits. And I also have a life insurance policy that I'm going to use for retirement income. Whatever income I'm receiving from the life insurance policy is not going to affect any amount of government benefits that I'm going to receive. It's invisible money to the IRS. Even if I'm taking 50 grand a year, it's not going to change my tax bracket. It's not going to limit the amount of Social Security money I can get. It's not going to limit any benefits that I'm getting from the government because they literally cannot see that life insurance money coming out and that I'm accessing it.
But if you take money out of your, for example, let's say I'm an LLC and I have a life insurance policy and I use my life insurance policy to pay my employees, for example. Yeah. Aren't you eventually going to run out of the limit that you have for your policy?
Yeah, if you're going to run out of money in the cash value, you should probably put some money back. Paying the interest back on the loan would be great. It's more so, do you want to use it again? Because if you want to use it again, you need to put it back. You know, if you pulled out money for something that it wasn't maybe it was 20% of your cash value and you have no intention of paying it back, fine. If you pulled out everything you have and, you know, you didn't use it to get yourself any farther and you're not putting it back, then you're not going to have anything left to pull. There's this idea of respecting the policy for what it is and how it works and making sure you always have money in there to keep it alive and keep it going so that you can keep utilizing it. Right? Even if you had a loan from the bank, you wouldn't just not pay the loan back.
Of course.
You would pay the bank back, right? You have to. Why don't we look at paying ourselves back in the same way? Why don't we feel this responsibility of like, I have to pay this loan back. It's going to me.
Well, I think part of the reason why is based on the design of it, right? It doesn't affect your credit score. There's nobody that's going to be hounding you.
True.
It's all on you to pay it back whenever you want. Theoretically, you don't have to pay it back for the rest of your life. I think that's insane. I never heard of that. You know, like I'm 30 years old, and if I wanted to get into the housing market today, and I had a life insurance policy at 21, that means I could have taken that money out, have been my own bank, not worry about the bank pressing down on me about paying back these loans, or else my credit score is going to be affected. They'll repossess my home. Like it's nuts that I did not know we had this as an option.
Yeah. It is.
In terms of affordability, though, I mean, $300 even in today's economy is pretty steep. What are some of the cheaper options that you have available in terms of a life insurance policy?
So, I mean, and it's technically not me, right? Like sorry, my computer's going to die, you guys.
No, you're all good.
Okay, we could take a moment, but everyone, I want to say I apologize about the it's lagging. I know we're live. I know this is a little lagging a little bit. I'm working on the Wi-Fi as we speak. So, but Casey is definitely doing an excellent job. Definitely adding information, and she's dropping gems on us. Definitely.
Ask me the question one more time.
Yeah, in terms of affordability for life insurance,
Yes. So, I mean, I like to recommend 10 times your age because I know it's like a perfect spot, right? Let's say you're 30 years old and I tell you 300, then, and you tell me that's too much, you can go lower. You could start with $100. You could start with $150. You just have to know that it's going to accumulate slower, right?
Mhm.
Either way, you're still building an asset. Either way, you're still working on building up the cash value. In a period of time, you are still going to have accessible funds. You just have to realize it's going to take a little bit longer. You either need time or you need funding, right? If you don't have time, you need more money. If you don't have money, you need more time.
Mhm.
And that's just how compound interest works. Time is the magic ingredient. So if you're 40, right, and I'm telling you 400 and you tell me 200, well, that's fine. Just know you're going to see less cash value growth because we still have to pay for the death benefit that we ultimately want to be able to maximize and utilize that cash value. So, yeah.
Rich, do we have any questions from the audience, or do you have any questions to ask?
Oh, it's my turn.
Yeah, it is. I mean, I still got some on handy, but I don't want to like take over the whole
You guys
thing.
usually go and do live podcasts, just as long as it keeps going.
Yeah.
Okay. Let's talk. Let's make it. Let's for our audience. So I know there's this between a life insurance agent that works for the life insurance
Mm-hmm.
and a life insurance specialist.
Okay.
And a life insurance broker.
Yeah.
Can you please explain that?
So, when there's life insurance agents, and they're also either captive or independent. So, a captive insurance agent sells life insurance for a specific company, a specific carrier, and sells it in the way that they want them to, right? That's a captive insurance agent. An independent insurance agent does not work for a specific company, does not follow a specific carrier's rules or their script, right, for selling the product, and can work at any carrier or with any carrier or any product they want to. So I am an independent agent. Now, a broker, an insurance broker is somebody who has access to a lot of different carriers and then gives that access to agents. Power 3 Financial is an insurance broker as well. So we have access to all kinds of carriers, and each individual agent within the company can decide which carriers they want to work with. Right? So I didn't used to be a broker. I had only direct contracts with individual carriers. I mean, I can go here, I can go there because I have a contract with each. And now I'm a broker. So I can go and type in an insurance carrier and ask to be contracted with them. And I already have it. It's kind of set up. Now you said one other thing. Brokers, agents, and did you say something?
Well, I said, yeah. So the life insurance agent that works for the insurance.
Okay.
The independent life insurance specialist and the broker.
Okay. So I got them all. Yeah.
So now that you them all, what my opinion for our audience that has been supporting us, I would recommend someone like Casey that is independent to set up your life insurance policy. I'm gonna tell you the reason why is because if you work for someone, if a insurance agent that works for the policy, that works for the insurance, if he set up your policy, it's only gonna work for them. It's not gonna work for you. Casey, am I correct?
You're correct, 100%. If I am a State Farm agent, you come to me, I'm going to sell you State Farm, how State Farm wants me to sell it to you, and I'm going to purposely figure out what commission I'm going to make and get that commission as high as possible. because I'm sitting here working for State Farm. I don't give a shit about somebody calling on the phone to State Farm. I care about myself. Duh, right? You're trying to support State Farm, and State Farm saying, call these people from, that have reached out to us or that call our hotline and sell them this because we know what they want. Whereas you call an independent agent and hopefully that agent is asking you what you want and how can they help you. As far as you call State Farm is going to say, this is how we help people. Right? Yeah.
So you're independent, but your policies, the policies that you offer clients, they're generated from what companies, from what entities?
Yeah. So I'm contracted with around 40 or so different carriers. I'm hesitant because technically it's a compliance thing that I'm not supposed to say what carriers work with. No, you're good. You're good. But let's just say this. I don't work with any life insurance carrier that sells car insurance, health insurance, home insurance, renters, nothing. If they don't only sell life insurance and then specialize in either whole or universal, I don't work with them. And I also refuse to work with companies that are rated lower than an A-. So they got to be an A-, A or A+ rated company in the industry. I will not work for anything less.
Mm-hmm. So when we sign up with a policy with you, is the customer or client disclose about the policy where it's coming from, or is it just strictly
immediately? Well, if you get me on the phone, I'll tell you everything. I'll tell you everything you want to know. I'll give you all the details about all the things. I usually tell people too, hey, this is the company I'm going to show you when we get on Zoom. Go research them, okay, and come back and let me know. Yeah, absolutely. I'm very transparent about everything that's going on, who I'm working with, those types of things. Once I'm actually working with somebody, it's the social media. I would have told, because I would love to brag about a couple of these carriers, but even, good press, if they allow good press, that means they can allow bad press. And so there you go. Because even on TickTock, I never say carriers because compliance.
So what makes you determine which policy to use, which company to use for what client? How do you determine that?
So it depends on the priority of the policy. If somebody's entire priority is the cash value, then we want to be in a accumulation product, right? And then I'll compare different carriers' accumulation products for that person. Now, if somebody they like the cash value, but they are more interested in the death benefit and the permanent insurance, then we're going to look at accelerator products, which are technically they're accelerating the amount of death benefit in that policy compared to the cash value. Cash value won't grow as fast, it's still growing. So there's just differences based on what's the priority of the policy for that individual person. Are they death benefit, cash value, or do they just want the living benefits? Some people just want the permanent insurance and the living benefits. And so there's different IUL products with different carriers, and you just kind of start narrowing down which ones make sense and which ones don't.
Yeah. Okay.
How can I start a life insurance policy with Power 3 Financial? Do we call? Yo, shout out to, I'm sorry, I don't want to say her name wrong. Chanel?
Yeah?
Yes. Shout out to Chanel. Yes.
Why?
Shout out to Chanel. Yes. But yeah, Power 3 Financial, do we have a call?
Yeah, do we have a call? So if you want to get in touch with me or anyone from my team, you can go to my Instagram, you can go to my TikTok. Everything is at Casey the Dollar, and you can request a phone call. You can also just submit a services inquiry, and you'll be set up with a phone call with an agent. You can also do a get started form and kind of get a lot of the information already out there so that we go straight into a Zoom call and go right into numbers. You can send me an email, again, CaseyTheDollar@gmail.com. And all of my information, the ways to get in contact me, even my cell phone number is on my Instagram, my cell, and my email. And the business website has all kinds of different options at power3financial.com to get in touch with us. So
let's go. So towards the ending, because we're a little pressed on time, and we have, because it's a 2-hour podcast, and our time is sons, we have about 30 minutes left. Okay. Is that okay with you, Casey? How much time do we have on your end?
Yeah, I got 20 minutes.
Okay, so 20 minutes. All right. So towards the ending, we're gonna ask you 3 questions.
Okay.
If you were in your younger self, I'm sorry, I said that wrong. I'm sorry. Okay. If you were your younger self, what would you tell yourself? Second, what is your final thoughts, and how can people connect with you and work with you? We got questions coming. I'm sorry.
Oh, this guy has so many people.
Yo, shout out to y'all for listening to this podcast. For a small business starting out, is it advisable that I wait until my business is earning more money, or could I start right away? What is the minimum premium for a small business?
Okay, so I'm going to drop something new on you guys here, because if you own a business, you have an LLC, and you want to get a life insurance policy, but the business isn't making a huge profit right now, but you know that later it will, and you want to have that asset set up, something we can do is we can actually set up a term policy. Okay. We set up a term policy for $30 a month, right? We do it for 20 years. We get a death benefit. We set up that policy. And the plan is that in 2 years, when you can start putting more money towards an IUL, we're going to convert the term policy for no underwriting, no medical, no labs, nothing, and turn it into an IUL. And now you start funding it and building the cash value. So from the jump, your business was covered with the death benefit, it had a life insurance policy, you did the medical, you got that out of the way. And now we just wait until you are in a place to start putting more money towards the policy, convert it over, and we're already insured. And so we just do a quick switch. So that would be my recommendation, because in some cases, if we're talking about a 35-year-old and the most we can put towards a policy right now is like $50, we could start the IUL, but it's going to be on such a small end that we're not going to see a cash value. We might as well start a term policy, have more death benefit, add more value to the business overall, and then get into a position where we can start putting more like $300 or $400 into the IUL, but not have to worry about being insured. And so just switched over at that point. Yeah.
Go ahead, Nairon.
Thank you. I'm glad you knew I had stuff. I'm still interested in your journey in terms of entrepreneurship, but I know we don't have the time for that. So if you can just quickly disclose to me how you discovered TickTock and how you used it to your benefit to propagate your business.
Yeah. Oh my gosh. Okay. So when I first got into the industry, I was working for another guy's company. I didn't have my own company yet. And as an entrepreneur in a commission, industry where you're trying to get clients, everyone a few years ago is starting to hear this idea of like, you got to get on social media and like talk about your business, find leads, whatever. And so beforehand, I mean, I had used TickTock to make like singing videos and whatever, and just like random stuff. But it never really went anywhere. So I had already been used to using the app a little bit. So I kid you not, you guys, I would sit on my porch. I would take the dog for a walk, and I would just say things in a video about, did you guys know that life insurance is like not for old people? Like it's actually like really cool. And I don't know why no one's talking about it and whatever. And these videos, I start doing little skits of, the bank. Like I pretended to be in one of my first viral videos. I was sitting on my porch. I did this skit. I had different glasses for each little person. And one was the bank, and the bank was saying, hey, give us all of your money. We'll pay you less than 1%, and we'll keep it safe for you. Don't worry. You can withdraw it. You can add more money. Like no big deal. Mm-hmm. But what we're going to do on the back end is we're going to go loan it out to other people and make 10%. So please keep your money here. And the consumer is going, okay, I don't know what else to do with my money. Like, I guess I'll give it to you guys, Mm-hmm. Life insurance company is on the phone with the bank going, yeah, you can make 10% each year. No problem. Give us all you got, perfect. And it was just this very simple idea. I was excited about it. TickTock liked it. It went crazy to the point that the next month, my calendar was completely full.
Really, what kind of numbers are we talking about?
We're talking about 300 phone calls in a month. 300 phone calls of just like, what's an IUL? What do you mean? How does it work? Like, what the fuck is going on? And I'm like, I've been doing this for a little while. I've read some books. I kind of know what I'm talking about. And, I'm doing my best here. And I was working in this company, right? And they were like, wow, Casey, like that's so great. I'm like, yeah, does anyone want to help me? Like, seriously, you guys, does anyone want to help me? Like, I can't answer all of these phone calls myself. And they were like, no, I don't want your internet leads. I was like, what do you mean you don't want you told me to go talk to people on the internet, and now you don't want to help me,
Right.
And Chanel, who's my business partner in Power 3 Financial, we own the company 50/50. She was over in that same company going, I'll help you. I'll help you if you want. And the big guy was saying, no, you guys have to stay away from each other. You need to make your own money. You go make your own money. And we were like, but why can't we just work together and take care of this? And he wanted us to be independent agents within his company. So he was making money off of both of us, right? And so one day, Chanel and I were like, we need to quit. We could do this better than how this guy's doing it. We can take care of all of the people on TickTok. Casey, you can keep posting on TickTok. We'll build a team of people who can answer phone calls and everything else. And so one day we just did it.
So you just quit your job. Be like, listen, I quit my job. Let's do independent. That's it.
What I hear is I quit my job stories. What about the security? You know what I mean? I always get a knot in my stomach whenever I hear the I quit my job story.
Yeah, quit everything. I didn't make money for 5 months. And even on the 5th month, it was like $500. And then the 6th month, I maybe made like $1,200. And I was just throwing money. I was going to buy that hair salon, right? So I had cash on hand. Threw it all into, I had to live, and I was paying for licenses, and I was getting the LLC and building the website. And without even trying, people on TickTok were reaching out to me. Hey, can I work with you? Can I work with you? Can I be on your team? Can I do all these things? I have a team of 9 people and a social media manager. Which if Farida is listening, hi, Farida. McCall might be here too. McCall found me on TickTok. So did Ryan, who are 2 agents from my team, found me on TickTok and got licensed without knowing anything about life insurance. And McCall right now is having multiple $10,000 months in a row, all from leads on TickTok.
So it's safe to say that TickTok is your main billboard.
And now, we're in Google, right? So we have had people call our office and say, hey, I found you on Google, whatever. And they'll be like, and if you ask them, do you know Casey? Like, how'd you find us? No, just on Google. Who's Casey? They just
That's how you know you made it, right? That's how you know you made it.
They don't even know. Yeah, you fucking made it, man. And then other people, they call the office and they're like, I'm trying to talk to that Casey girl from TickTok, and people, I have 84,000 followers on TickTok now. In a little over a year. It's not crazy, but it's
wait, you started the TickTok thing a year ago.
May of 2021.
Get the hell out of here.
Yeah. It's some blonde girl with the tattoos talking about life insurance that intrigues people. I don't know.
Wow.
I don't know. I recently had my biggest video ever. I've never seen 1 million views before. I got up to 700,000 a couple weeks ago. It was my first biggest video. But
so shameless plug. Mention us and this podcast the next time you do a TikTok, please. You know.
Well, I do appreciate Kate and her team because they promoted this hard.
We promoted this hard, yes.
Oh
yeah,
wow.
They promoted this heavy. Thank you.
And I mean, in the future, you know, I have like a really amazing social media manager to do, you know, promotions and things like that. We would be nowhere without the social media promotion and, you know, of just the business and of what we do in general. So I got lucky to have found her. So
I also think your tattoo artist got lucky too, because I think all of his tattoos are now being seen by hundreds of thousands of people.
True, right?
Wow, but that's incredible. I would love to talk to you more about the whole entrepreneur thing, you know, how you manage your day to day. You don't have that much time, but like the next time we speak to you,
yes,
keep in mind those are some of the questions I have about what it's like to be.
I want to come back for sure.
So if you want Casey to come back, drop it in the comments right now.
Yes.
Drop it in the comments right now.
Casey will come back. Is there a question?
Yes, there is a question.
Okay.
If you offer IUL to employees, do employees have to get medical exams?
Good question. Sometimes it's going to be a yes. Sometimes it's going to be a no. It's going to depend on which carrier is basically the ones behind offering the benefit. There are a lot of insurance carriers out there that say no medical, and that's totally fine. But even if they did have to do a medical, you know, again, they come out to your place or they'd come to the office and do all the medicals. But you could also have it set up with it's called a right-away process, as in they just write it right away. And you don't have to do a medical, but you do have to fill out a more extensive medical questionnaire. So we have some options there. Yeah.
Let's go. Okay. So how much time we got left, Casey?
Like 10? Yeah.
All right. So 10. So that means 5 on the dot. We got to go.
Okay.
So last question, Nyron.
Oh man, last question. Oh man, God, there's so many different ones I could ask. I think probably the most pertinent. Yeah, the most pertinent. What kind of life insurance policy do you have, and how do you what do you have multiple life insurance policies? If so, not what are they, but how do you manage them, and does your company independently have its own life insurance policy?
Oh, okay. Now you're hitting it.
So the goal is for the company to have an IUL 100%, whether it's on me or it's on Chanel, just to build up the cash value, to have the coverage, to practice what we preach. You know, the company is not making enough money at this very moment to be funding a cash value policy adequately. We should get a term policy. I'll tell you, if I'm being honest, I need a health insurance policy first before I can get a life insurance one, because your girl needs to go to the doctor. And so there's only like adult things that I can do at once. So I'm working on that. So it's in the works. Now, as far as life insurance policy goes, IUL, of course. I won't say the name, but putting in just a casual. Like when I started it, I wasn't sure how much money I was going to make, right? I'm young. I'm 27, so I'm a little bit younger than both of you guys over here. But $250 going in and $2,500 as a lump sum on top, so that I created room for myself for later years of the policy, right? $250 is $3,000 a year. You add that $2,500, it's $5,500. So I can put around $6,000 a year into the policy, but I'm only paying $250 a month. So I'm only paying half of that. And then there's extra space. And the policy has only been open for a year. So we have a cash value of around like $400. But that's just year one. And I'm not fully max funding it yet. I plan to have it there as something I can use to throw extra money at. And my ultimate goal is to have an IUL with a 7-year funding period where I fund it for 7 years and completely max it out and do a lot higher premiums in that one. So I want my working asset that I fund for 7 years to just sit and stay there. And when I'm ready to use it for whatever, I literally can't put any more money into it. And it's just compounding for me over time. And then just a long-term one that's smaller, more manageable. And that's the whole plan as of this moment, since it's just me, just to,
Yeah, just see yourself and you.
Yeah, me. So insurance, crypto, TD Ameritrade for stocks, and next thing is real estate. So, which I have to have 2 years of tax returns for that bad boy. So we're so close. We're so close. So close and so far. Yeah.
Wow. Okay.
Wow. Okay. So that is, hold on. Send me an email at dc@diamondcashincentives.com.
All right. Well, for the audience members that can't see what's going on, we just have people asking us questions about joining CNN or whatnot. Either way, in terms of, I know we're limited on time, but can you talk really briefly about the benefits, if there are any, of having more than one life insurance policy?
Yeah, absolutely. I mean, the benefit would be that you have two different strategies, right? One strategy is you're doing a shorter funding period, more money going in. And the goal is that in 7 years, it's completely funded and it's just sitting and working for you, right? The other strategy would be we do a long-term funding period of smaller, more manageable premiums that you stop funding around retirement age. So maybe that one you're using it for retirement. You're not going to touch the money inside the cash value at all until you're done putting money into it. So if you're 30 and you're going to retire at 60, you're going to fund it for 30 years. You're not going to touch it within the 30 years, and it's going to become a retirement income. Now, the other one, you fund it in 7 years, and maybe on year 8, you have over $100,000 and you're going to take 50 out and go buy a property, get renters in there, pay that $50,000 loan back. A couple of years later, you do it again, and you're not having to pay for this policy at all. It's just your bank. So you have a policy for leverage and a policy for retirement.
Perfect. Perfect. Succinct. I know we don't have that much time. Thank you so much for answering my questions.
Of course.
Okay. So we have 5 minutes left. 5 minutes. We respect time on this podcast. Aaron, I just sent you. I hope I'm saying it right. I'm so sorry. But my email is dc@diamondcashincentives.com. Casey, so before we wrap out, I have 4 last questions for you, and this is going to close it out.
Wow, 4? Jesus. In 5 minutes?
This is going to close it out. So, what books do you recommend? I'm going to start off with, what books do you recommend?
Yeah. Okay, books I recommend. First one is called The Retirement Miracle by Patrick Kelly. Okay, it's like 150 pages. It talks about the history of the IUL, the benefits of it, and who it's good for. They talk a lot about business owners. The Retirement Miracle by Patrick Kelly. Number 2, The Laser Fund by Doug Andrew. Laser stands for liquid assets, safely earning returns. Okay. It's a fantastic book. It is hefty though. There's a first part and a second part. The first part does all of the numbers and the mechanics of the IUL, and the second part talks about real life stories and case studies. Okay. Those two for sure. And then of course, I'm a big Rich Dad, Poor Dad girl. I love his book, The Cash Flow Quadrant, though. Not his Rich Dad, Poor Dad. It's The Cash Flow Quadrant by Rich Dad, Poor Dad. And he talks about an employee mindset, an employer mindset, business owner mindset, entrepreneur mindset, all the different ways that money flows in and out of your life and how you think about it and how you can create a sustainable business. So those are my recommendations for you.
Let's go. Now, what would you tell your younger self right now?
I would tell my younger self. Okay. Tell my younger self. I'd probably just tell my younger self, keep fucking going and to take every risk that you're scared about taking, because the ones that you're the scariest about, I think they pay off the most. And so I'd rather take the risk and fail. Younger self, take the risk and fail as opposed to never taking the risk at all, because no matter if you just learn things or you actually achieve what you wanted to, you're winning either way.
Let's go. Okay. Final thoughts.
Okay.
Final thoughts, then how can me and the audience work with you, and how can they connect with you? Well, final thoughts first.
What final thoughts?
Yes, first.
Yeah.
Final thoughts about what? And about
in general, your final thoughts about the podcast, what you've been doing.
Final thoughts are that you guys have obviously an awesome following that they're coming in. I mean, because you guys talk about everything, and so to have me on here talk about life insurance is honestly so cool. I've never done a podcast before, you guys. So
we're the first ones.
No, it was my first one. I was so nervous, and you guys, it was so fun. The questions were amazing. Some questions that I don't get very often either, that a lot of people don't think about. So I'm just grateful to be here. I know, Rich, you had found me on TickTock a while ago, and so the fact that it's all come to this is just really cool. And I hope to get to come back.
You will come back, absolutely. Yes, they already said it. Like, they already said you will come back.
No, if you leave the podcast and you think it sucks, I'm going to be offended. All right, so don't come back unless you mean it. Don't come back unless you mean it.
So we gotta wrap out. So how can we connect with you, and how can we work with you?
Follow me on TikTok and Instagram at Casey the Dollar. My name is Casey Dahl, but I'm going by Casey the Dollar. And you can go straight to email. I answer people's emails that are direct emails to me all the time, every day. So send me an email if you want to talk to me directly. On Instagram, you can find my email and my phone number. Don't just randomly call me, like send me a text or something. But you can also go straight to my website, power3financial.com. We have a services inquiry button, set up a phone call button. You can go, the phone call from the website goes straight to me and Shawnell Raver, who is my business partner. So no matter what, you're in good hands with one of us. And we're available all the time. I work 7 days a week because I'm an entrepreneur. So feel free to reach out anytime.
Let's go. Let's go. That's it. Thank you so much, Casey.
Thank you. We really appreciate it.
Yeah.
I know we gotta go. So that's gonna be the end of the episode. And we are out, y'all.
We're out. Peace out, everybody. Thank you.
Thank you for listening. If you like this episode, please, I really appreciate if you subscribe to the podcast, whether you're on YouTube, Anchor, iHeartRadio, Spotify, Google, TuneIn, whatever platform. Please subscribe. Give it a like. And if you're listening on Apple Podcasts, write a review. Thank you for listening. Hope you enjoyed it.